In previous videos on my channel, I have touted holding the S&P 500 is the simplest thing for retirement. And I have done that in my own personal retirement fund, which you can see in previous videos. But after getting some inspiration from other YouTubers, getting better historical performance from combining ETFs like SCHD and VGT or QQQ, it got me thinking if there's an even better way to do this, and it turns out there is a much better way. I'm about to reveal a portfolio that beats the S&P 500 by about 4% every year and has less drawdown historically. Buckle up because it's going to be interesting. But as usual, none of this is financial advice. I'm not a financial advisor.
Knowledge.
Now, I need to shout out my brother who has got me thinking about utilizing TQQQ for a buy and hold strategy. If you don't know what TQQQ is, it's a triple leveraged QQQ fund on a daily time frame. So all this means is if QQQ moves 1% in a day, TQQQ moves 3. If QQQ moves minus 1%, TQQQ moves minus 3%. Degenerate? Yes, but doesn't mean we shouldn't discount it as an investment vehicle. I'm not going to go in this video how the specifics of this fund works. That's outside the scope of this video. But all you really need to know is TQQQ tracks QQQ on a daily basis in a triple leverage sense. Now, people say you shouldn't buy and hold TQQQ due to its volatile nature. But they're just mad, guys. They didn't put $10,000 in TQQQ when it first came out. You would have almost $700,000 now when it first came out in January 2011. You heard me right. Almost $700,000 from a $10,000 investment about 14 years ago. And you would have been a millionaire at some point. Now, even if the expense ratio is 0.88%, guys, for TQQQ, this thing would have made you a millionaire at one point. Don't complain about a 0.88 expense ratio with TQQQ, and that discounts it as an investment vehicle. But the main reason people don't hold it is due to its volatility. How would you feel about going from a millionaire December 31st, 2021, all the way down to a little over a 200,000-aire? 80% drawdown, just about 79%. How would you feel about doing that in a year? This is why most people don't hold it as their main fund. It's too volatile, and most of us don't have the stomach for 80% drawdown going from a millionaire to a 200,000-aire. I mean, still, you only start with 10 grand, so it's still a good return, but that's a lot of swings. But the question is there a way to utilize TQQQ, the power of the NASDAQ that has been on a tear for 2 decades now, to enhance our portfolios while staying sane? So I need to introduce you to the power of using SCHD and TQQQ. We all know what SCHD is. It's a Schwab dividend ETF that has smaller drawdowns, consistent dividends, and consistent price appreciation. You've seen a million videos about it. But what happens if we combine it with the degenerate triple leveraged QQQ to capture those crazy upward movements? Turns out this is really awesome. So I have Portfolio Visualizer up, and now you can see what I am talking about. So let's start with our standard funds, guys, right? We have to compare it to VU, because that is the standard, the S&P 500, and that'll be Portfolio 1. Portfolio 2 is going to be a combination of SCHD and QQQ, which we see on YouTube and does have good returns. So let's do a 50-50 split. And then Portfolio 3 is going to be our TQQQ combo. And we're just going to start out with 90% of SCHD and 10% to TQQQ. So only 10% of your portfolio is in TQQQ, 10% is the degenerate part, 90% is safely in SCHD. And let's see this results. And we're rebalancing annually, which we'll get to in a moment. Look at these results, guys. They're just ridiculous, holding a triple leverage fund with SCHD. So Portfolio 3 is our TQQQ fund. Keep that in mind. So our max drawdown is less than our SCHD and QQQ and less than SPY. SPY had a max drawdown of 23.91% since December 31st, 2011, since that's when these funds don't go back farther than that, so we can only go to that date. But we can see the final balance is incredible. With only 10% in TQQQ, we have a $70,000 balance compared to SPY, which is $47,000. And this still smokes the SCHD QQQ fund with a smaller max drawdown and a smaller worst year and a very large best year compared to these two. And you can see how in the chart, it smokes it in almost every time period. Even after COVID, it came down and ripped back up. So it's really incredible what having a stable asset, but only 10% of your portfolio can really do to increase the gains. Now, let's say QQQ crashes, QQQ falls. Remember, that's only 10% of your portfolio, and the other 90% is SCHD, which makes this really powerful. But we have to keep in mind, rebalancing is really important in this, because let's turn this off. And then let's see the results from this. Now, if we never rebalance the portfolio, that means we just put in $10,000 and never adjusted our percentages since we hold it, we can see the SCHD TQQQ fund absolutely smokes everything else. But this gives us a lot of volatility. Our max drawdown is now 62.01%. So if you can't handle that, if you can't handle seeing your portfolio crash by 62%, like December 31st to December 31st of 2022, this isn't the fund for you. So that means you do have to rebalance. It means you want to keep, by the end of the year, we're doing rebalancing annually. You want to make sure 90% of your portfolio is SCHD and 10% is TQQQ. So you're always rebalancing that to keep the funds in line so you're not over leveraged in TQQQ. Although it will give you better results, $111,000 compared to the $70,000 earlier, but your max drawdown is way out of whack and most of us will not be able to stomach that. So if this is a fund we have to rebalance to keep ourselves sane, this will make more sense in a tax advantage account so you can rebalance annually to avoid those taxes. Now, if you do hold it for a year, the taxes are better, but if you're going to be doing this almost every single year, that is a lot of taxes to accrue, and in my opinion, not financial advice, this would be a best portfolio for a tax advantage account, as rebalancing will definitely be a major component as it changes our max drawdown from 62% back down to about 24%. That's a big difference. I know most of you wouldn't be able to stomach it seeing a 62% drawdown, so just keep that in mind. Now you may be wondering, what happens if I literally bought at the peak? TQQQ had a massive drawdown from its all-time high in December 2021. Guys, TQQQ fell about 82%, okay? So what happens if we bought right at the top? Let's say that was the beginning of the year, January, and we're like, I'm going to try out this portfolio, and then we get this big sink. What would our portfolio look like if we decided to start it on this date? Well, let's backtest it and find out. So if we started in 2022, that would have been right here, this big fat red candle, and then we get this massive drawdown. What would our results have been to today if we keep our portfolio the same? If we put $10,000 in 2022 with 90% SCHD, we still have a great return. We can see our max drawdown in the TQQQ SCHD portfolio, max drawdown is only 21%, and we still have the greatest final balance and the best worst year in a sense. Why is that? Because SCHD actually had the smallest drawdown during this time period out of SPY and QQQ. So 90% of your portfolio is SCHD, and then TQQQ went on a rip. QQQ went on a rip. So what happens? It rips up, giving you the best final balance. Now you can see here, it did go under for a moment in October during that downfall, but then it came back up. So there will be periods where other portfolios might perform, but you can see in general, you can see this portfolio even outperforms in a bear market, even though you're holding a triple leveraged fund. Only 10% of your portfolio is in TQQQ. Even if QQQ blows up, it's only 10%. Most of your assets are in dividend growers, stable assets that give you dividends. And SCHD has the smallest max drawdown since COVID. That means a lot of stability. And just to recap what you guys just witnessed, this is a portfolio that beat the S&P 500, has a smaller risk, and beats any financial YouTuber's hypothetical portfolios. Of course, this is another hypothetical portfolio, but this is the best I've seen on the internet. If you know a better portfolio, please comment down below because I'd be really curious. So what happens if we increase our TQQQ holdings? So let's compare different holdings for our TQQQ and SCHD. So we're going to delete all this. So let's say we're going to keep our 90-10 and let's do two different portfolios. Let's say we did a 75-25. 75% SHD, 25 TQQQ, and let's do something like 85-15, and then we have 90-10. And let's analyze the historical, then we'll analyze the bear market and see what happens. And historically, it would make sense portfolio 1 would perform the best. That's the most degenerate, and QQQ has been on a rip. But we have to keep in mind, this also had the worst max drawdown, minus 30% compared to minus 24%. I guess that's really minus 31. But your balance is a lot higher, $137,000. Almost double of that. So, I mean, for a minus 30% drawdown, it'd be like holding only QQQ. This has been a really solid run. So really, guys, you can determine how much risk you want to take on with this. Remember, SHD is the most of your holdings, so it will be risk adverse, but you still have the percentage you want for how much risk you want to take on. So if you want less risk, maybe a 90-10 split, which will give you a small max drawdown over the past, 13, 14 years or so. Or you can do more where your max drawdown is only 30%. And I bet you this actually outperforms holding QQQ, SHD and QQQ. Let's test that out real quick because I'm curious. So let's get rid of our conservative portfolio. Now let's put 100% in QQQ and see what the results would have been. So portfolio 3 now is QQQ. And turns out portfolio 1 would actually be full holdings in QQQ. It has less of a max drawdown, a better worst year, and it smokes the final balance of just holding QQQ, which is absolutely hilarious, guys. This is just the funniest thing I've seen in a bit. So guys, this is not financial advice. Just because this has good historical results doesn't mean this will do well in the future. But if I said I wasn't tempted to try this after seeing these results, I'd really be lying to myself. But as of now, I'm not going to make any changes in my retirement portfolio since my main focus has been on crypto and it will be my main focus for the next year or two. But this might be something for you guys to try. As we can see, a little bit of financial degeneracy can greatly change the historical outcome of our portfolios. And after this, if you're wondering if SHD alone will be a great path to retirement, make sure you watch this video right here because the results may surprise you. Peace.